This is the Silicon Valley real estate market update. We update it weekly. It's for November 22nd. Here are the key chapters that you can jump to in the YouTube description below with the associated graphics. Basic concept is slides 2 through 4 are going to be a recap. 5 is micro markets, which I think is really important. 6 is how to participate. 7 through 9 is distributions. 10 comes back and looks again at Silicon Valley as a whole. 11 looks at the 3 counties, Santa Clara, San Mateo, and Alameda County individually. 12 and 13 are data tables for those that want the raw numbers. 14 is where we expand in Northern California in 5 regions, 13 counties. And then 15 is the data for that. So let's get into the first data slide. This is showing Silicon Valley data. You're looking at 3 different metrics. The first one, the most important one, is the market balance. That's the gray line. A high number here favors the buyer, a low number favors the seller. You're about 108% of your normal level. That is within the 12.5% range that I would consider normal. So it's a little slower than normal, but it's still what I would consider normal. It's made up of 2 components. The first component is inventory. Our inventory is in the purple line. You can see that's at about 103% of normal. Again, very, very close to normal. You got to remember that normal is defined by the past 10-year median for the same week. And this year, you got to pay attention. Thanksgiving is as late as it possibly can be, and holidays have a big impact. Thanksgiving is a big holiday. Some years, we would already be into the holiday week on the data because I start my calendar year on March 1st, go forward 7 days at a time. And November 22nd can be the earliest Thanksgiving is. What happens is sellers are reluctant to put their house on the market coming into the holiday weeks. That happened this week. There was noticeably less inventory. Buyers will still be out this weekend looking and buying. So there will be a bigger dip created by the actual activity. And then next week, you'll see a huge surplus, not next week, but the week after that, because next week you'll see the continued offers. The week after that, so 2 weeks out, you see the inventory come back. And the third component is actually the offers accepted. You can see that we're continuing to be down here at about 81% of the normal levels of offers. And if you go back and look, and I'm not sure why that changed colors, it's supposed to be this more orangey color instead of the browner color, and then it changed here. But anyway, the multicolored line is the offers accepted. And you can see right after the pandemic, we were at about 70%. Then we got up just shy of 80%. Now we're just over 80% when you average this out. Moving on to the summary table. Now what we're doing is looking at metrics. You're going back a quarter. So this is recent history instead of historical history. You're starting off with market balance. That's days of unsold inventory. That's how quickly it would turn over the marketplace. This is supply-demand balance. You were at 118% of normal at 48 days. Now you're at 37 days. So a significant speed up of the market in raw terms, but not that dramatic of a speed up in percentage. Yes, from 118 to 108 is an improvement, but that's only an improvement of 10%. But if you look at your raw count, that improved by a little over 20%. The slowest you'd expect to have is 45 days at this time of the year. The normal is 35. The quickest you'd expect the market is basically 22. That's how long it would take to turn over the marketplace, sell every listing at the existing rate if no new listings came on. Basically, think of it as market balance. Next one is market timing. That's the length of time the typical seller, which is the midpoint of those that come on and sell right away, and those that take forever to sell. And that's the 75th percentile, 3 out of 4 sellers. How long are they taking? It was at 34 days. It's now at 33 days, an improvement of 1 day. But now look at the dramatic improvement in percentage. You were 150% for all intents and purposes just a quarter ago, and now you're at 105%. So that's a significant improvement. That means it's taking less time for the seller to sell for the typical seller. We don't look at the quickest sellers because they're going to sell in 7 days. We're looking at the typical seller, the seller that doesn't sell that first weekend. Moving on to price reductions. This is a measure of not the supply demand, but sellers' expectations versus market reality. In other words, when they put the house on the marketplace, the price they come out on the market at is sort of where they expect the market to be. The price reductions increase when they miss the market on the high side. So if they overshoot, then they have to reduce the price. but the vast majority of sellers do no price adjustments. The average a quarter ago was 165, so 1 2/3%. Now it's a little less than one, it's 1.4, just under 1.5%. The middle of the graph, this line right down here, is the current week data. Going back to the left is the data for the past 13 weeks, in the purple, the past quarter. Going forward, the three colored lines are trend data. The red is always going to be favoring the seller. The gray is where you'd expect the market to be, and the blue is a typical marketplace. So you can see, as far as marketing time, the top end and the bottom end get very close together right here at the end of the year. But we're between where you'd expect the market to be and a slow marketplace. And then we're only 5% above. It looks to me like we're not that close, but that's what the math says. Price reductions, now we're at 1.4. So that's 32% more of a price reductions than normal. So 1.4% may sound less than, a small number, but it's actually a third greater than we normally are doing. But that's a huge improvement from where we were a quarter ago at 90% more price reductions, larger magnitude, almost double, not quite 185, but cut that number in half, call it maybe 0.9, maybe even 1% if you're being generous. Somewhere between 0.9 and 1% price reduction is where you typically are. So you were, 80% more. Overbidding. This is the pressure the buyers feel. Now, if you come back a quarter ago, the buyers weren't feeling much pressure, 2.8% when it was normally 5.9%. So they were 3 percentage points below. They were half the overbidding that they normally are. Come forward just 13 weeks. They're now overbidding 5.3%. They're almost overbidding double what they were at a time when the overbidding normally goes down. So they're overbidding now by more than is typical. So a complete reversal of the marketplace in just the last 13 weeks. And a word of caution on timing. Overbidding requires the sale price, so it lags behind by 3 to 6 weeks, depending on the time of the year. In a fast marketplace, the duration of escrows tend to shrink because buyers tend to be more competitive with their offers, and it tends to grow during slower periods of time. Inventory. This is just the raw counts of what's available for buyers to look at. We were at 102%. We're now at 103%. Again, that's exactly normal. We have 2,000 listings. We're at a time of the year where that number comes down pretty dramatically and increasing. You can see that we're going to be way down here in just a couple weeks. We've already dropped 800, which is almost 20% of the marketplace. Offers accepted. We were at 79% of normal. We're now at 81%. Again, no shift as far as how we're doing, but we are missing a significant percentage of the marketplace, and we have been missing that ever since the market correction back in 2022. I would say basically from July 1st of 2022, and maybe even a little bit earlier, we've been missing 30, then 20, and maybe, 30, then maybe 22%, and now maybe 18% of the marketplace. So we are missing some of the market out there, which is somewhat significant. And then closed transactions on here, just more of a point of interest. We're basically we're closing 75%, 3/4. Now we're closing 80%. Here is the summary chart of the micro market. So this is where it becomes important, because if you look at like San Mateo County coast across here, everything is blue. So the San Mateo County coast is favoring the buyers right at the moment. If you're a buyer and you want to live in Half Moon Bay, that would be a good time to buy. But then if you just go down and look at something like Foster City, it's mostly red on the left-hand half and a little bit of blue as we get over to the right-hand half. So you got to pay attention. Or in Santa Clara County, you got South County, which is pretty much blue all the way across. And if you come down to Cupertino, Sunnyvale, it's red pretty much all the way across. Where you're looking, the market varies significantly. So what we have here is sort of the leading indicators in the bright highlighted yellow. We have market balance, marketing time, price reductions, magnitude, and we introduce frequency. So now you can see only 1 in 5 sellers reduces their price, which is why the average price reductions are so small. Then we have 2 indicators that are lagging, both of which are overbidding. So we need that sale price. You have the magnitude and the frequency. Then if you come over here, the green, this is comparing where we are compared to the previous 10 years. And if you look overall, there's a lot of blue. So that's saying the market right now is favoring the buyer more than it normally does. A slower marketplace, less competition than normal. Now, again, each micro market can be different, but overall, the market is slower than it normally is. So even though it's still a competitive marketplace out there and things are moving quickly, it is more favorable to the buyer than it normally is. Then we have two that are not highlighted, and that's because they're really not indicators. They're lagging, but they're things of point of interest. One that's pretty unique that I don't know very many people that follow is the appreciation. And one of the things you can see right off the bat is Santa Clara County is 84% appreciation. That's the highest of the three. Then you have San Mateo at 71%. And then finally you have Alameda County at 66%. But that's since 2015. And when you're leveraged out, that gives you a pretty good rate of return on your down payment money and your closing cost money that you've invested. And then you have the sale price. And instead of following just the median, which is the middle number, I add on the cheapest 10 percentile on the left-hand side of the middle and the 90th percent, the most expensive, on the right-hand side. The goal is to give you a price range in each micro market area. And then here's some details for those that are doing it on their own. And here is actually the first map. I've changed the order up a little bit. I've tried to make the presentation a little bit more organized. I've been doing this since 1997, and I wanted to integrate and sort of re-go through and make it not so piecemeal. This is the market balance. I still call it days of unsold inventory or turnover rate, whatever you want to call it. Anything under 42 days, 6 weeks, is what I consider to be a fairly fast-paced marketplace. You can see that the two counties, Santa Clara and San Mateo, are under that 42. Alameda County is right at the 42. But even in Alameda County, look at the huge difference. You have two areas at about 120 days, Castro Valley through Pleasanton, so sort of the Quad City area out there. But then you also have some areas that are fairly hot, 28 days, and then Oakland it's basically 60 days. So again, there's a huge difference. And even in San Mateo County, you go from 20 days to 90 days, depending on where you're looking for. In Santa Clara County, you go from 24 days to 73. So not as widespread, but again, it gives you an idea where, and the color on the map really shows you where the hot spots are, where the cool spots are, and where the sort of market's sort of normal. Here now is comparing the DUI, the days of unsold balance, the market balance, compared to the 10-year median, or where we normally are. So you can see the percentages are all above 100, but they vary from as low in San Mateo of 106%. So San Mateo is the closest to normal. Then you got 111 in Alameda County is next. And you'll notice I don't have micro market data for Alameda County for the first couple slides. And then finally, in last place, believe it or not, is Santa Clara at 14% slower than it normally is. And that would be favoring the buyer, but we're not quite to the magnitude where I start shading it blue. Here's marketing time, same concept. Where is it the fastest? It's basically 32 days everywhere except for Alameda County where it's 35. But again, it ranges. It ranges from 23 days to 62 in Santa Clara. It ranges from 12 days in Foster City to 88 days. And in Alameda County, it ranges from 26 days in Fremont up to only 41 days in Pleasanton. It's sort of interesting to see Pleasanton on 41 days and much slower than normal, and the days of unsold inventory so high. What that's telling me is a fair number of people in Pleasanton are coming on the market and slowing down the days of unsold inventory, but aren't selling, so they never impact the day's marketing time. Marketing time is only for successful sellers. Market balance includes the unsuccessful sellers. So when you see a large discrepancy like that, you start looking at a large number of sellers that aren't selling. Here's marketing time for 3/4 of the people that sell. You can see that Pleasanton is at 50% slower than it normally is. So those that are selling in longer periods of time. San Mateo County is actually faster than normal, with Foster City on fire selling in half the time than they normally do. And that is normally a fast marketplace. That's why Foster City is bright red. Most of the Bay Area is white. The coast is sort of a shade of blue. Here now is price adjustments. Blue would be a lot of price adjustments. Red would be no price adjustments or very little. In the case of Foster City, it's actually a price increase. So a couple sellers are coming on the market. They're getting so much activity. They're raising their price before they accept the offer. But again, you can see a large amount of blue. That would tend to say more price reductions than normal. But again, you have to come in and look at the number. The numbers here are small, but this is average. That's one of the reasons I like looking at the 90 percentile. This is the magnitude for compared to the 10-year median. So now you can see some areas like Mountain View, Los Altos, Palo Alto, have Cupertino, Sunnyvale have less price reductions than they normally do. Redwood City is having a lot less, but then you have South County, the Cambrian, Santa Clara, Willow Glen area having more. Fremont, basically the Bay side of Alameda County has quite a bit more price reductions than normal. So larger price reductions than normal. Here's the frequency of price reductions. This is where you can start getting an idea on how uncommon price reductions are in Santa Clara County. Only 12% of the sellers at Milpitas, Blossom Valley, Berryessa, Santa Teresa are reducing their price, all the way to a high in Saratoga, Los Gatos of almost 40%. So you go from 1 in 9, 1 in 8, 2 in 5, and you can see the range. This is the frequency compared to the 10-year median. So the frequency of price reductions is pretty darn close to normal. Overall 106%, 109, 99, and 109. You're either 10% above the number or you're at the normal number of price reductions. So it's not more common, but sellers that are doing price reductions are taking larger price reductions. This is the magnitude. Now we're flipping over and looking what the buyer is doing, and we're introducing the timeline. So here you can see where the hot marketplace is. If the buyers are overbidding a lot, that means there's a lot of competition. So the island of Alameda up here and Berkeley, Cupertino, Sunnyvale, plus Palo Alto, Los Altos, and then up in the northern bay side of San Mateo County, the cool spots are the coast and the Pleasanton area. Here's looking at overbidding compared to 10-year normal. So it's fairly close to normal in a good part of the east central Silicon Valley, hot along the peninsula, cool on the coast, cool up in Hayward, cool over in the Central Valley portion of Alameda County, and then it's cooler down in the South County of Santa Clara County. Here's the frequency of overbidding. Very infrequent overbidding in Morgan Hill. Only 23% of the sellers get overbid. And that makes that still sound like a lot, but here in Silicon Valley, it's rare to get below about 15%. So 23% is getting pretty close. Going over to the San Mateo County coast, you're at 9. So that's actually below you rarely get below numbers. So that's one of the things you'll find in statistics. You always have those perturbations. Only 1 out of 10 sellers is getting a price overbid in San Mateo coast. Here's the overbid frequency. So how common is it compared to the 10-year median? So you can see it's cooler in most of the outlying areas. It's almost normal in sort of the inner areas, and it's hotter than normal or more overbidding as far as frequency in Redwood City. Here now is looking at the appreciation. You can see where the hot spots of appreciation have been. Pleasanton has popped up now as a hot place, but the surrounding areas are a cool place. So there's a lot of fluctuation. There's been a lot of change because of the pandemic, in my opinion. Here's pricing. So this is simply affordability, not market conditions. The blue is the most affordable areas. The red is the least affordable or the most expensive. And again, you have the sandwich price, the low on the left, the high on the right, and the middle is the median. Here is the inventory. I cut off the top, but this is your active inventory. So what percent of normal? Because raw count on inventory wouldn't be very meaningful. So this is only comparing inventory to normal. Where you have a high number, you have more inventory. So I would favor the buyer. Overall, Santa Clara County is favoring the seller at only 87% of the inventory. So it's down 13%. San Mateo and Alameda County are right at it, 2 and 3% more inventory than normal. Real estate is dissimilar enough that you have to give a lot of leeway on the fluctuation of the stats. Offers accepted. You can see that overall we're at 80%. Santa Clara County is only at 75%. It's missing a full quarter of the marketplace. San Mateo County is only missing 5%, and Alameda County is missing 20% of the market. Here again is a summary. We discussed that at the beginning, so it's just up there for a recap. We've been talking about the Silicon Valley real estate marketplace. We will continue to talk about Silicon Valley, but then at the very end, we'll talk about the Greater Bay Area. If you want to participate live Saturday morning, you can type in the green root URL plus 2025 for the year, or you can type in the longer Zoom meeting and their passwords built in. If it asks for it separately, it's up here for you. If you want a handout, which I got up early this week, you type in the green root URL, the letter H for handout 2025. This week's would be 11 for the month and 22 for the date. or you can type in the much longer Google Drive, which is where it's hosted, and that is for this week. And then if you want the archive, you can type in the YouTube channel, which is at Silicon Valley Real Estate Market, or you can type in the Green Root URL by itself and get there. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers here in Silicon Valley in single agency transactions. Here's just a highlight of some of the things that I do for buyers that want to work with me, a link to the details of the listing, add in the Google Maps so you can get a better idea where the property is located. I can add in the great school ratings or the school names if you prefer, and I can write in commute times that are custom for you, whether it be 5 o'clock or 6 o'clock or 8 o'clock at night, to get your commute times to the different areas, which makes the data much more useful. Here's some data for those that are looking on their own. Let's get into it. Here we're looking at the marketing time for the distribution. So we're looking at all transactions from 50%, the median, because look how little this number changes. So it's not much, the numbers would get closer and closer together as the closer you got down there. So I thought it would be better to have a large scale to display the data versus displaying data that really is meaningless. I do a lot of my focus here on the 75th percentile. If I was to do it over again, I'd probably do it on the 80th percentile, but 75 is a lot more significant. It's the third quadrant or the beginning of the fourth quadrant. What we're doing here is we're starting off a year ago on the dotted line. The purple line is the current line, so you can see they're right on top of one another. So marketing time is exactly normal. We jump forward 1 week at a time for 5 weeks, then we go 2 weeks at a time, and the most current 5 weeks, we go 1 week at a time. What the concept is, the first several slides is showing you where the market's going. The last several slides is showing you where the market had been. So let's get into it. You can see the market slowing down, so you'd expect marketing times to get longer. That right there is probably the peak with slowest marketplace. That's already coming down. Now you're coming down significantly. Look how steep it got over here on the right-hand side. Now you're at the bottom, so that's the hottest it got on February 21st. Now it's already cooling off, and it's just walking its way up, getting cooler and cooler. So the market time, if you want minimum marketing time, you want to go on the market right around Valentine's Day. Each thing that's important to you as a seller depends. There was July 26th. It was the coolest the market was, the longest it was taking. Now look how much the market's heated up. So we had and now it's going to turn around and slow down. So from the middle of October, it's been slowing down. So we did have a noticeable improvement in the marketplace from the end of July to the middle of October. And now, again, the purple is where we are now. And this is simply how long is it taking this typical seller to sell their property. And it's only measuring the successful sellers again. Moving on and looking at price reductions. Here I've elected to only look at 15% of the marketplace. I ignore the highest 2.5%, because that can be statistical fluctuations. It can be data entry errors, things of that nature. And I don't go below the 82.5%, because below 82.5%, the data is mostly zero. Now, right now, it's not zero and I would gain anything. But a year ago at this time, the data was already up here at zero. The concept is the same, so I'll jump right into it. You can see how much the market cooled off. So you start at the purple line and expect the market to cool. There's the coolest on December 20th, not quite the end of the year. Look how rapidly the market comes up. There's the peak on February 21st. That's the same as the previous data. Now you're cooling off fairly rapidly. Right there again is the bottom of the marketplace, right around August 26th. Yeah, it looks like maybe it got a little cooler on September 6th, but then it improved and then it's coming back down. And now we're at the coolest right there. We did have an improvement this last week, but again, that's probably just a more situation where how many sellers are going to reduce their price going into Thanksgiving week. It's not the timing, it's just the wrong time. So you had less price reductions this past week. Overbidding. Again, reiterating, we bring in the 5-week lag time here. The important thing is when the offers were accepted, but we don't have the sold price until the offers are closed. And that lag, the duration of escrow, is that what introduces that 5-week lag period. So same concept. You can see we're really not moving it very much, in part because of the 5-week lag. Now you start seeing drift down. 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 And there's the bottom on January 24th. So later than you'd expect, rapidly improving. There's the peak of the market on March 22nd. But if you take a 5-week lag, you're back to February 22nd. Now the market's slowing down fairly rapidly. Slowing down. And right there's the bottom, August the 23rd. But again, if you take off 5 weeks from August 23rd, you're back to that end of July timeframe. Now the market heated up. And there's the peak, I think. And now it cooled off the last 2 weeks. The reason I didn't pause it is the last 2 weeks, even though they're down slightly, are fairly much at the same level. But based on the time of the year, I would expect next week to be less. Here again is some more details for those that are reviewing on their own that may have a question. Here now we're looking at all of Silicon Valley. We're looking at the individual metrics. You have the gray line, which is the typical, that's where you'd expect the market can be. And here you can start seeing the annual cycles. The blue, red is the least, the fastest, the favoring the seller the most. The blue is favoring the buyer the most, and the purple is the current data. So this is the speed of the marketplace. So you can see the balance of the marketplace is your turnover rate is somewhere around 38 days. You would sell all your existing inventory at 38 days. That's the definition of turning over the marketplace. Here's percentage of normal. So it's a little bit slower than normal. You can see just at the beginning of the quarter, which would have been October 1st, we were very close to normal. But you can see earlier this year during second quarter, halfway through second quarter, we were way slower than normal. We were 70% slower than normal. Here's marketing time for the typical seller. So a related number, you can see you're very close to the normal line. You can see that you started off the year faster than normal, rapidly got up to slower than normal, stayed slower than normal. Then halfway through third quarter, we started basically approaching the blue line. And then right before the end of third quarter, we dramatically improved and then did an abrupt turn and went up. You wouldn't expect that kind of fluctuations, but this was that market improvement that we saw that I was pointing out, end of July 21st, I think the dates were. Here's percentage of normal. So you can see how much slower that we were than normal for duration of marketing time, 80% longer to sell. Now you're back maybe 4% longer than normal. So basically a normal marketplace. Now, this is the metric I like on price reductions, and I don't highlight it because it's sort of a bizarre one. It's what is the 90th percentile? What is the seller that's essentially taking the largest price reduction doing? And they're taking a 14% price reduction. So if you have a $2 million house and take a 14% price reduction, that's $280,000. That's more than $250,000 price reductions. So the price reductions that are actually happening are a large magnitude. The reason the average is so small is so few sellers are doing those price reductions. Here's a frequency basis. You can see that price reductions were actually more common than normal. They're still more common, but they're only about 10% more common right now than they typically are. This now is looking at the average. You can see the pattern's the same, but the magnitude is a lot different. Instead of being 14% price reductions, the price reduction is only 1.4%. And that's because we added a whole bunch of sellers that take no price adjustment whatsoever. Here's the average reduction on a percentage basis. So we still are taking bigger price reductions than normal, even though it's only 1.4%. This is the frequency of price reduction. So how common is it? Basically, right around 21% of the sellers are doing price reductions. I would call that pretty darn close to normal. Again, the pattern, you can see you were taking more price reductions as well as larger. And then you sort of did that plateau during the summer months, and then you actually did the improvement, and now we've regressed a little bit, but we're basically in a period of time when the trend goes up. Now, once we hit the first of the year, you expect those price reductions to come way down. Here's the frequency compared to normal. So you're basically 15% more frequent price reductions, but you were almost 80% just, 2 quarters ago. Here's overbidding. You can see overbidding is almost normal. And this is the magnitude of overbidding for Silicon Valley. You can see you had you actually had more overbidding first quarter, then rapidly came down and had less overbidding. The bottom was right about the middle of third quarter, which would be probably more like the middle of August. And you go back 5 weeks and you're basically the middle of July. Overbidding above and below normal. So you can see that you were overbidding less than normal. And this is just raw count. This is where I pointed out the buyers were paying 3% less overbid than normal. Now they're actually overbidding about 0.5% more than they normally overbid. So we've gone from less overbidding compared to normal to more overbidding than normal. Here's the frequency. 60% of the sellers are getting overbid in Silicon Valley overall. Now, granted, it's only 1 in 10 over in San Mateo County coast, but that means it's greater than 60% of the sellers in some areas. And I suspect Cupertino is one of those areas. Here's the frequency. So even though 60% of the sellers are getting overbid, that's less than normal. It's only about 95% of the normal frequency of overbidding. Here's my pricing model. I'm basically maintaining about 12.1% appreciation for somewhere around 7 years, and then basically flat for the last 3.5 years. Now, granted, there was a price overcorrection here in 2022, 2023. So, if you wanted to do a little dip, you could. But what you really can do as a real estate agent or even a consumer is pretty much any comp since middle of 2023 is going to be accurate for today's pricing after you adjust for these high points in the summer and the low points at the end of the year. So it really opens up your number of potential properties that you can use as comps, in my opinion. Here now we're looking at, this is active inventory. I changed the order, trying to put the more important metrics up front. Inventory by itself really doesn't tell you anything. The ratio between the two is your turnover rate. Inventory by itself doesn't tell you anything, but it does tell you how much selection the buyer has. And you're basically right on top of the gray line. So absolutely normal inventory. Offers accepted. You can see that we're below the gray line, so we're missing. And it's the vertical separation from the gray line that's important. So straight up here to straight down here, it's not the horizontal. Horizontal, we look like we're only off by a small amount. Here's again some notes for those that are following on their own for the upcoming graphs. Now what we're doing is we're going over the same metrics in the same order, but we're breaking out the 3 counties. So San Mateo County is in the orange, Santa Clara County is in the blue, and Alameda County is in the gray. This is looking at the turnover rate time, the market balance time, the turnover time. You can see that San Mateo and Santa Clara County are right on top of each other, about 34 days, and Alameda County is still a respectable number, but about 43 days. Here's the marketing time. This is how long it's taking the typical seller to sell. Very similar numbers, 32 days for both Santa Clara and San Mateo County, but a much lower number in Alameda County at 36, lower than the turnover rate. The turnover rate was 42 days, marketing time's only 36. And that would say it's got a higher TFT ratio than the other 2 counties. Selling ask price reductions average, you can see San Mateo is doing the most price reductions, but again, it's a reasonable number. It's 1.7%. You get into Santa Clara and Alameda County, they're basically tied at 1.3% price reductions. So, but again, that number is misleading because it's an accurate number, but it's misleading because so few sellers take price reductions. Now we look at the frequency of price reductions. All 3 counties are very close together, about 20.5%. So basically 1 in 5 sellers does the price reductions, which means 4 out of 5 sellers are not doing a price adjustment, which says their expectations of the market were in line with where the market was, or they did a good job of doing their homework. Here's the average overbid. Alameda County has the highest amount of overbidding at 7% over the seller's ask price, followed by San Mateo County at 5.5%. And the least amount of overbidding is good old Santa Clara County at only 3.5% over the seller's ask price. Frequency of overbid, all 3 very close together. It looks like it's from 59 to 62%, but all right at about 60%. So 62% of the sellers are getting more than their ask price for all 3 counties. This is the appreciation rate. You can see Santa Clara County's outperformed up here at almost 100% appreciation. Then you have San Mateo County and Alameda County. San Mateo is higher, numbers up here at about 76%. Alameda County is probably down around 65, 66%. Here's the sold price. I called out the numbers here just so you could see it. So San Mateo County is $1,970,000 for the median sold price. Santa Clara County is $1,900,000, and Alameda County is $1,230,000. Here again is that was on log paper. This is on regular paper. Again, the callouts are for you. You can see the separation a little bit easier on this graph. But logarithmic paper is first because I think it's more important because you can tell the rate of appreciation by the slope of the line. Here's the payment using the national rate for 30-year fixed high balance conforming loan limits. Here's the active inventory. Alameda County's got the most inventory at just under 1,000. Santa Clara County is under 700 listings for all of Santa Clara County and its 2 million residents. And San Mateo County is at 400 listings. Here's the number of offers, 400. So San Mateo County has a turnover rate of about 35 days. Santa Clara County is at about 700. Alameda County is just shy of 500 offers. And I look at offers accepted versus pending. The difference is pending is typically those transactions that are currently pending. Offers accepted, I look at offers based on the offer dates. Every listing that accepts an offer is given the same weight when you look at offers accepted. If you look at a pending transaction basis analysis, those that are pending for a longer period of time impact your stats for a longer period, and those cash transactions that tend to be quick impact your data for a short period of time. Here's the number of offers that are accepted. You can see we're now 7 out of 10, so there's 3 years that were less good than we currently are, but we're pretty close, 1885 to 1852, and this number will go down 1946 to 1914. So, and here you're within 17. So some of these 7s may become 8 still, but we're not as bad as we were earlier this year when we were the worst out of the last, second worst out of the last 10 years and second worst out of the last 25 years. Here's numbers, and I've expanded a little bit for the different counties, Silicon Valley, Santa Clara, San Mateo, and Alameda County, the different metric, and then the different sub-metric within the metric. Now we move on to the Greater Bay Area, 13 counties and 5 regions. The 5 regions are here and the associated 13 counties. Here are some definitions for those going through their own, or if you have a question that I didn't address to your satisfaction in the presentation. Moving on to market balance, market turnover time. You have 2 regions very close together, Silicon Valley being the fastest at about 37 days, closely followed by cities at about 40 days. Then you have another pair with Central Valley coming in slightly faster at about 67 days, call it, and then North Bay at about 70 days. And 5th place and last place is Central Coast at about 86 days to sell over your entire marketplace. Here's the time for the typical seller to sell. The order is the order's the same, but the magnitude is pretty different. Silicon Valley is the fastest at basically 33 days. The cities that was very close on turnover time is all the way up to marketing time of 50 days. Central Valley has a marketing time of 64 days, but North Bay that was very close to it has a marketing time of 78 days. Central Coast that was in last place is actually tied basically for last place at 76 days, so slightly faster than the North Bay. So there's a technical reversal there. And a lot of that has to be due to successful and unsuccessful seller proportions. Here's the percentage of ask price reductions. So this is the average. So these are lower numbers than you would expect because they're way down by all the zeros for those sellers that do no price adjustments. The area that's taking the largest price reduction is the Central Coast at almost 4% of a price reduction, followed by North Bay at about almost 3%. Then you have Central Valley just over 2%. The cities right at 2%. And the area that has the least amount of price reductions is Silicon Valley at about 1.4% price reductions. This is the frequency. The cities in Silicon Valley are very close together. We had basically 20.5 days for Silicon Valley, probably about 23 days for the cities. And then the other 3 regions are basically in a tie right at 40%. If I was to read it carefully, I would say that the Central Valley and the Central Coast are at about 39.5%, and the North Bay is about 40.5% of the sellers are doing price reductions. Here's the overbid. So flipping over and looking what the buyers are doing. The highest amount of overbidding is in the cities, followed by the Silicon Valley, and it's pretty different. The cities is coming in at about 8.25% over the seller's ask price. Silicon Valley is coming in at about 5.5%, maybe 5.3% over the seller's ask price. The remaining three regions are below the seller's ask price, with North Bay about 1/4% below, Central Valley 1/2% below, and Central Coast 2% below the seller's ask price. That may not sound like a lot, but to get that average there, there's some overbidding going on even in the Central Coast. The percentage of the sellers that are doing price reductions in the Central Coast has to be pretty high. Here's the frequency of overbidding. You can see the most frequent overbidding is the cities at about 63%, followed by the Silicon Valley at 60% even. Then you drop way down to North Bay at about 34.5%, Central Valley at about 31%, and in last place, as is frequently, Central Coast at about 21% of the sellers getting more than their ask price. Here's the appreciation long term. Again, it's going to be this way for a while. It looks like cities has the least appreciation, and it's basically down here somewhere around 40%. You can see that pre-pandemic, it was right in there doing like all the other regions were, came up, had the pandemic, fell down, and has been below ever since. Although in the run-up, it did pretty well, but ever since the 2022 collapse, it's been down and hasn't come close. Then North Bay is in second worst position, Central Coast, and actually Silicon Valley is in fourth place, leaving the Central Valley for the highest rate of appreciation at about 88% appreciation. Here you have the median sold price for the Greater Bay Area. You have the cities being the highest price at about 1.7 million, followed closely by Silicon Valley at 1.6 million. And then you go down to Central Coast at about 1,050,000, call it. Then you drop down to North Bay at 800,000, and the most affordable region is the Central Valley at about 550,000 for the median sold price. Here's the same information, but this is the monthly payments. So by the same, it's going to be the same order, same pattern, but it does take into consideration interest rates. I assume an 80% loan at the high balance conforming loan rate. So you can get lower rates than that and therefore a lower payment by going jumbo money. And if you have retirement funds or stock investments, you can do relationship pricing with your lender and get even lower rates. But the order is going to be roughly the same. You go roughly from about $4,100 in the Central Valley up to the cities at about $12,500 for a monthly mortgage payment. Here's active inventory. You can see inventory is going down in all the regions. The least steep is Central Coast, but it's still going down. The others are all fairly steep, as is common for this time of the year. This is the number of offers accepted. You can see the offers accepted is going up in two regions, being Central Valley and North Bay. They are both going up fairly significantly, but then going down insignificantly is the cities. It's fairly flat. Going down a little steeper is the Central Coast, and then going down the steepest is Silicon Valley. Here's the numbers, and instead of the presentation of raw numbers for 3 weeks, I do the now, which is the current week data, with the percent change from last week, and then the percent change from 5 weeks ago. We've been talking about the Silicon Valley real estate market and the Greater Bay Area, 5 regions, 13 counties. This is how you join Saturday morning live at 9 a.m. Handout if you are interested. The archive. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers or sellers, single agency transaction in Silicon Valley. Reach out if you have any questions about statistics, how you'd like me to improve my presentation, what data you'd like to see that I'm not presenting, and if you have a real estate need. Take care. Bye for now.